Okay, so you've joined us, and we've got this pretty substantial report in front of us. The Central Bank of Ireland's quarterly bulletin, Q1 2025.
It is quite hefty, yeah. Lots to digest.
Exactly. And let's face it, not everyone has the time to wade through all of that. So that's our job today, right?
Absolutely. Our mission, if you like, is to pull out the really crucial bits.
We want to pinpoint what you actually need to know about where the Irish economy is heading and what hurdles might be coming up.
And it's not just numbers. There's a real narrative here. You've got forecasts, sure, but also analysis,
Yeah.
global factors, domestic ones.
Labor market, public finances, the whole lot.
Right, so think of this as, well, your shortcut to getting up to speed. We do the heavy lifting.
Okay, let's dive in then. First thing that really seems to stand out, this big theme, is uncertainty. Policy uncertainty specifically.
That jumps right out, doesn't it? It's kind of the dominant theme early on, and the main source, according to the bank.
The U.S., right, the new administration over there.
Exactly. The policy signals coming out of the U.S. and how other big economies might react. That's creating ripples.
And we're talking things like tariffs, non-tariff barriers, that kind of thing.
Potentially, yes. That's the concern being flagged. New barriers to trade possibly emerging.
So this isn't just like a vague worry, it's actually feeding into their economic forecasts.
It is. They're still forecasting growth, steady growth out to 2027.
Okay.
But this uncertainty is expected to act as a drag. It's likely to weigh on consumer spending, business investment decisions.
Exports too, I imagine.
And exports. So the overall growth trajectory is looking a bit slower than they thought in the last bulletin.
Right. A definite headwind. And the report really hammers home how Ireland is kind of uniquely exposed here, doesn't it? Because of our U.S. links.
Hugely exposed. It's a critical point. It's down to those very strong transatlantic ties. Think about all the U.S. multinationals, the M&Es, operating here.
Yeah, the big names in pharma, medtech, ICT.
Precisely. They're deeply woven into these global value chains.
So it's not just that they're based here, it's the actual flow, the trade itself.
Absolutely. It's quite intricate. Irish exports and all the benefits that come with them, they're tied up with U.S. investment, but also, interestingly, with imports from the U.S., especially services.
Wait, imports, how does that work?
Well, the report points out we actually run an overall trade deficit with the U.S.
Seriously, a deficit?
Yeah, because the value of the services we import from the U.S. is so high, it outweighs the surplus we have in trading goods. It really shows the depth of that services relationship.
That's surprising. I wouldn't have guessed that.
It highlights the complexity. And it goes further. A lot of what we export actually relies on inputs sourced from elsewhere. And the U.S. is the biggest supplier of those inputs.
Okay, so stuff we bring in from the U.S. goes into products we then export.
Exactly, especially in those key M&E sectors. Take pharmaceuticals, for example. About 15% of the total value of Irish pharma exports actually comes from components imported from the U.S.
Wow, 15%. That's significant. Makes you very sensitive to any changes in U.S. trade policy then.
Very sensitive. Any friction there has a direct impact.
And where do these exports eventually end up? Is it mostly the U.S. market?
Well, the U.S. is a major destination. Almost 20% of the final value ends up there. But actually, the EU is still the largest single bloc for final demand for Irish goods and services.
So we're kind of caught in the middle of these global flows, with the U.S. playing this really crucial, sometimes indirect role.
That's a good way to put it, a very intricate web.
Okay, so back to these potential tariffs and barriers. What's the direct hit on the MNEs here if that happens?
Well, the report suggests it could be pretty substantial. Depends on the details, obviously. But it could hit the relative profitability of operating in Ireland.
Which means they might rethink investment.
Yeah.
Or activity levels.
Exactly. It could influence those decisions. Remember that 15% pharma input figure? If tariffs hit those inputs, it directly affects the cost of making things here.
And the worry goes beyond just tariffs, doesn't it? Like broader policy shifts.
That's the concern, yes. The trade issues might come alongside bigger changes in, say, tax policy or industrial strategy globally.
Making Ireland potentially less attractive overall.
It could. It could further disincentivize investment here. That's flagged as a key downside risk. And actually, the bank notes that even the current uncertainty, just the not knowing, is likely already having a dampening effect as businesses hold back on big decisions.
Right, that makes sense. Okay, so lots of potential storm clouds globally, but domestically the picture seems better, especially jobs.
That is the positive counterpoint, yes. The Irish labor market has been remarkably resilient. unemployment is still bumping along at historic lows.
And it's not just the headline rate, is it? There's some underlying shifts.
Yeah, what's interesting is they talk about a fall in structural unemployment. That's the baseline level, even when the economy's doing okay.
Okay.
And they also see evidence that people are finding jobs more quickly now, structurally higher job finding rate. They think it might be linked to higher education levels in the workforce.
More skills, easier to get hired, seems logical.
In theory, yes. Though they do also note that the really intense cyclical tightness in the market seems to be easing off a bit now.
So supply and demand coming into better balance.
That's the idea, more balance. So the outlook is for steady job growth and wage growth that kind of tracks productivity, which is generally seen as, well, healthy.
And inflation.
That's
Are we
right.
past the worst of it, according to the bank?
The forecast suggests domestic pressures should stay relatively contained,
hmm
even with maybe some bumps from energy prices in the near term.
Why sense a but coming?
Well, yes. There are definite upside risks to that domestic inflation picture. And the main culprit flagged is infrastructure constraints.
Ah, yes. Housing, transport, energy, the usual bottleneck issues.
Exactly. Those constraints can push up domestic costs and keep inflation stickier than it might otherwise be, even if global factors ease off.
So our own internal limitations could keep prices higher for longer.
That's the risk, yeah. Tackling those bottlenecks sustainably is pretty key to keeping a lid on domestic inflation down the line.
Okay. Now, let's pivot slightly. Monetary policy. The ECB. They cut rates recently, didn't they?
They did, yes. The European Central Bank lowered its main policy rates. The deposit facility rate, for instance, is down to 3.25%.
So policy is getting less tight across the Eurozone?
That's the assessment, yeah. As inflation comes down, policy is becoming less restrictive.
But given all this uncertainty we've talked about, they're probably still being cautious.
Very much so. They're really stressing a data-dependent approach, meeting by meeting. They want to see more proof that inflation is definitely, sustainably heading back to that 2% target before they make any more big moves.
Watching the numbers closely makes
Yeah.
sense. Okay, beyond the immediate cycle, the report also looks at longer-term stuff like generative AI. That feels like it's everywhere now.
It really does. And it's interesting how these big structural shifts are intersecting with the economic outlook, even now. The bank's looking at, how AI might impact different sectors.
And are we ready for it, skills-wise?
That's the question they raise. How well equipped is the workforce? Their initial research points to sectors like professional services, personal services, education. Healthcare is having quite high potential exposure here in Ireland.
Exposure meaning jobs at risk.
Not necessarily.
Yeah.
They actually suggest that in many of these areas, AI could be complementary to human workers, working alongside people, boosting productivity.
So humans plus AI equals greater output, potentially, not just replacement.
That's a key part of the discussion. But, and it's a big but, making that happen requires investment,
Investment in.
both physical capital, the tech itself, and crucially, human capital, skills, training, education. We need people equipped to use these new tools effectively to get those productivity gains.
Right, we need to adapt. Okay, so all this adaptation, growth, fixing infrastructure, it all needs funding. Where's the money coming from?
Good question. Public money plays a part, obviously. But the report highlights other potential sources, like Ireland's big pool of household savings.
Our savings. How would that work?
Well, savings have been trending up, and people are holding less in simple bank deposits, more in other financial assets. This pool of capital could potentially be channeled into funding businesses doing essential work, housing, renewables, transport upgrades.
Interesting. Using domestic savings for domestic investment. And they mentioned savings and investment unions, SIUs.
Yeah, they suggest that strengthening SIUs could be one way to do this. Offer better returns for savers, provide more funding options for businesses, especially maybe smaller local ones. There are challenges, of course, in scaling that up.
But the potential is there. What about housing specifically? Always a massive issue. What's the bank's take on unlocking supply there?
They focus on the construction sector itself,
Mm-hmm.
making it more investable, more sustainable, so it can actually deliver affordable homes efficiently.
And how do we do that?
It's a mix of things. Boosting productivity using modern methods, getting economies of scale, also making better use of zoned land, and having enough service land available through good infrastructure and, critically, a more efficient planning system, especially in cities.
The planning system. Yeah, that comes up a lot. Sounds like a complex puzzle.
It is. And on top of housing, there are all these other demands on public funds, aren't there?
You mean like energy infrastructure for climate goals?
Exactly. Energy, water, transport, maybe even defense spending now, given the geopolitics. big capital needs.
And this is all happening while day-to-day spending pressures are also rising. Aging population, healthcare costs.
Precisely. It puts the public finances under significant strain.
Which brings us back to another key vulnerability the report flags.
Our reliance on corporation tax.
Exactly that. We rely heavily on corporation tax receipts. And a lot of that isn't even tied directly to what's happening in the domestic economy. It's linked to those M&Es.
And those receipts are vulnerable to the global shifts we talked about earlier.
Very vulnerable. Geoeconomic changes, trade tensions, they pose a real risk to that revenue stream.
Plus, the report mentions we have a bit of a habit of spending more than initially planned. Yes, that pattern of expenditure overruns is noted as a concern. Managing spending within budgets has been, well, a challenge.
So it all points towards needing a really clear strategy for public finances.
Absolutely. The bank stresses the need for clear policy direction. Things like having an effective fiscal anchor, maybe broadening the tax base so we're less reliant on corporation tax, really prioritizing capital spending, and making structural reforms to boost private investment. It's a whole package.
A multi-pronged approach needed then. Okay, let's get some concrete numbers. What are the headline forecasts for 2025?
Okay, so for 2025, they're projecting modified domestic demand growth. That's the measure of the core domestic economy.
Right, stripping out some of the M&E volatility.
Exactly. They see that growing around 2.7%. Unemployment, they expect it to tick up slightly but stay low overall. The forecast for the average rate in 2025 is 4.6%.
Still very low historically. And inflation.
Headline inflation, HICP, they see it easing from 2025. Services prices will be the main driver, but the overall rate is forecast at 2.2% for 2025.
Okay, so moderate domestic growth, low unemployment, easing inflation. That sounds reasonably okay, but laced with risks.
Absolutely laced with risks. They are very clear. The risks to that growth forecast are tilted firmly to the downside.
Mainly because of the global trade situation, the U.S. connection.
Primarily, yes.
Yeah.
Escalating trade tensions are the big worry for a small, open economy like ours, especially with those strong U.S. links. Protectionism hurts us disproportionately.
And inflation risks. Could it stay higher?
Yes, that's a near-term risk. If those infrastructure bottlenecks aren't tackled properly, inflation could be higher and stickier than forecast, especially if, say, fiscal policy becomes too expansionary, adding more demand pressure.
And you mentioned risks within specific sectors, too, related to the multinationals.
Yeah, that concentration is a risk factor. Pharmaceuticals, semiconductors, ICT services. These sectors can be volatile, depending on global tech cycles or decisions by just a few massive firms.
And some activities are more footloose than others, easier to move elsewhere.
Exactly. Particularly in the M&E services sector, activity might be quicker to scale back or relocate if the environment changes. That creates uncertainty.
And finally, just circling back to the public finances, those risks remain prominent, too.
Definitely. The uncertainty around corporation tax revenues, combined with that tendency for spending overruns, it means the fiscal projections have significant downside risks attached. It underlines the need for really careful management ahead.
Right. Well, this has certainly been a thorough walkthrough. Hopefully listening to this deep dive has helped make sense of the central bank's latest assessment.
We hope it's given you, the listener, a clearer picture of the key forces shaping the Irish economy right now, the path ahead, and the potential bumps in the road, all based on the bank's analysis.
Absolutely. And maybe we can leave you with a final thought, something to chew on, considering how deeply Ireland is plugged into these global value chains and how much we rely on a few key sectors. How can we as individuals or businesses actually prepare for this future of potentially greater global uncertainty and maybe shifting trade patterns?
That's the big question, isn't it? How do you build resilience in that kind of environment? Definitely something worth thinking about.